Thank you, and good morning, everybody. Now I'm going to cover some similar ground to Innes, but I do have a few pictures I think that draw out some of the points that he's made. But I'd like to start first with just a little bit of a look back, because an Australian economist's proudest boast over the last few years has been how we've clocked up 25 years of continuous economic growth, and how it was only going to be a matter of time before we overtook the Netherlands as the country with the longest running expansion ever recorded. In fact, I made that claim when I was here this time last year. But of course, a big question mark over our ability to hit those targets came through with the latest readings that we had on economic growth in Australia. The economy went backwards in the third quarter of last year, and the pessimists who have never been far below the surface over the last 25 years came back in force at that point. So, is it all over? Is the question I wanted to start with, this chart here just shows you what's been going on. So a very simple chart showing economic growth in Australia. You can see those red bars there, the quarterly growth that we had, and the drop at the third quarter of last year is pretty apparent. What that chart also shows, though, is that the occasional decline in long-run expansions is not unusual. I've circled the other events that we've had over that 25-year period. And what it's always proved to be is a case of one step backwards, but then followed by two steps forward again. So the occasional interruption is not unusual. What that negative also reminded us is that the weather matters. It was, in many parts of the country, in the third quarter of last year, the wettest period that we've ever had, or at least as long as the records go. Had a big negative impact on construction activity, parts of mining as well. Well, it's blue sky out there today, so that kind of weather effect should disappear when we see the next reading on economic growth in a few weeks' time. What the numbers also reminded us, I think, is the importance of politics on occasion as well, because that negative outcome coincided with what was one of the longest run election campaigns that we'd had in Australia, one that was very divisive, one that took us a while to work out who had actually won, and one that brought with it a lot of concern about the ability to push legislation through the Senate. And those political issues, I think, had a big negative impact on business and consumer confidence at the time. Now, those things are still present, I think, but they have dissipated somewhat. So the bottom line here really is, I think, a lot of what we saw in that growth pothole in the third quarter was just that. It was a temporary factor. It wasn't the start of something more sinister. Now, we shouldn't get too caught up, I think, in the sort of blow-by-blow moves in economic statistics. They are volatile. They do change direction from time to time. But what gives me the main comfort that we will continue on this positive growth path and that we will take out that top spot on the global growth front is the knowledge that the big commodity-related headwinds that have been weighing on the Australian economy have pretty much blown their course. And this set of charts here just makes it clear, I think, just how big the boom and bust in key parts of that commodity story have been. Over the last, it's certainly the biggest cycle we've seen in the last 160 years. So falling capital spending, the green line on the right there, well, it's something that's weighed on spending in the economy overall, and it's also had a negative impact on jobs. Chart on the left, commodity prices, well, that big fall in commodity prices that we've seen has weighed heavily on Australian incomes overall. And while we may not have kind of met the technical definition of a recession, I wouldn't argue too strongly against the idea that the last few years has really been something of an income recession in Australia. That weak income growth, I think, was always the major risk in the outlook because it was so pervasive. If I look at businesses, for example, if you've kind of lost control of the revenue side of the equation in a sense, then controlling the bottom line is all about costs. And that has negative risks for areas like capital spending and labour hiring. Government, similar sort of story. Revenue is consistently fallen behind what they'd hoped to achieve. If you do want to wind the budget deficit back to balance, then obviously a heavy focus has to come through on spending, again with a potential negative for economic activity. For households, well, if your income's not growing strongly, then it just limits your ability to spend full stop. I think the risks here have been accentuated in some ways as this period of income weakness has coincided with a period of extreme policy settings around the world, particularly the very low interest rates that we have here and elsewhere. So it's all been about how can I generate some extra income, where can I find some yield pickup, where can I pursue some sort of capital gain. That's all been done in terms of trying to generate more income, but it does mean that we've all taken on more risk as a result of that. So I think the most encouraging news that we actually have about the outlook for Australia is that commodity prices have picked up. The outlook for income has improved, and also I'd add the drop in mining capital spending is almost complete. So we heard the Governor of the Reserve Bank, for example, say last week that he thought about 90% of the decline in mining capex is now behind us. A little bit more to come, but most of the bad news is in place. So more income coming through. Less of a drag on the spending side. So in a sense, it should be easier for the Australian economy to grow from here. The commodity story again, it is shifting the income dynamics for the Australian economy, and a couple of charts here I think just make the point. So the chart on the left, it shows you the Commonwealth Bank's commodity price index, reflects our specific mix of commodities. You can see the pickup that has come through. And while we're still a long way below those very high levels we had a few years ago, commodity prices today are around about 46% higher than they were this time last year, which was more or less when the low point was. The chart on the right-hand side, though, shows you where the income is starting to flow into the Australian economy. It shows you Australia's trade balance, and in a matter of months we've moved from running trade deficits of around about $4 billion a month to a record trade surplus of $3.5 billion. Well, that swing of $7 billion or so is a measure of the extra income now hitting the Australian economy, and that's each month. So it's a very significant shift in the income flow. It'll go through to company profits, and the current reporting season we're starting to see a little bit of that come through. It'll go through to government revenues. And for the first time in a very long time at the federal level, revenues are actually running ahead of what the government expected to see. And eventually we'd expect some of it to sort of trickle down into household incomes as well. Now, I don't want to suggest the rivers of gold that we used to talk about a few years ago are returning. Without a doubt, some of that increase in commodity prices will be unwound as we move through 2017. But again, the point to make is that big drag is over. The income recession is certainly finished. Well, it's good news, of course, if the negatives are behind us, but where are the positives? What is actually going to drive growth in the Australian economy over the next few years? Well, there's 4 areas that we're watching pretty closely when we're thinking about that part of the story. And the first of those is just yet another part of the commodity story. The chart on the left-hand side here, the blue line, just shows you the outcome of that massive mining capex boom. It's boosted our mining capital stock to levels that we've never seen before, and of course that capital stock is now generating production and export for Australia, with plenty more to come in terms of rising resource exports. It's going to be a major driver of economic growth over the next couple of years. And of course the weather also matters here when we're thinking about the outlook. That same rain that weighed on the economy in the third quarter has been a positive for other parts such as agriculture. And every Economist pack has a weather map in it at the moment, and mine's there on the right-hand side, and probably a bit hard to read, but all those blue areas show you parts of the country that have had above average rainfall, and it's pretty much everywhere except Western Australia, of course. So it does mean we're going to see a very significant lift in agricultural production this year. In fact, we've heard the official forecasters only a day or so ago lift their estimate for the winter grain crop in Australia to 59 million tonnes. That's about 20 million tonnes higher than last year, and it's a lot of extra wheat bix that will have to be consumed as a result, but it is going to be a big contributor to growth in the economy. If I move on from there, the other 2 areas we're looking at is firstly infrastructure spending. Finally, we're starting to see some lift in this critical part of the economic story come through. And the chart on the left-hand side here, it shows you a survey by Deloitte's Access Economics, and they work out the value of all the committed investment projects in Australia. So these are ones that have been signed off, they're going to happen. You can see the lift towards the end of the chart there. And when you go through the detail, what's driving that lift is public spending in transport-related areas, particularly in New South Wales and Victoria. So it is infrastructure finally coming through. And Asia is going to remain an important source of growth for the Australian economy. That income growth that Nick's referred to is something that's providing plenty of opportunities for different parts of the Australian economy. The chart on the right just gives you a bit of a snapshot of what's happening. Looking at China, black line there, GDP growth, the thing that we normally focus on, it has slowed. But the other lines there are just different measures of income growth in China, and they're all still moving ahead at a decent rate. And that increase in income is generating opportunities in a range of areas, and particularly in the services side of the economy, with tourism and education being the standouts there. And just to give you some indication of the potential upside, my China economist tells me that around about 5% of the population in China have a passport. Now, if the rest of the population get a passport, you can only imagine the potential upside to the tourism story for Australia and in fact, for the rest of the world. Now, if I start to put some numbers on this, well, we think that resource export boost is worth about 1% to growth. The farm boom potentially adds another 0.5%. Infrastructure is also worth about 0.5%. The Asian income story around about 0.75%. Now, unfortunately, we've got to give some of that back because the drop in mining capex isn't quite over yet, and it does look like the residential construction story is getting near a peak. So it leaves us with around about 2% growth banked in, if you like, but we're hoping to get to something closer to 3%. So we do need a few things to happen to fill in the gap. And there's two areas in particular that we need to focus on. In Australia's case, that extra growth, I think, needs to come from business, and it also needs to come from government. And there are certainly opportunities there when you look at the Australian capital stock. The chart on the left-hand side looks at that capital stock, so the value of all our farms, factories, ports, railways, hospitals, schools, and the like. And there's some pretty clear trends that stand out. Our stock of economic infrastructure, our stock of social infrastructure relative to the size of the economy is back where it was in the 1970s. We've allowed that stock to deteriorate in a sense, and there's a pressing need, I think, to expand that, get it back to more normal levels, if you like. For that to happen, though, I think governments need to lose their fear of debt. Selling assets, ploughing the money back into new infrastructure is great, but we need to do more than that. And frankly, I think borrowing in the current environment is something that we should be looking at a lot more closely than most governments are prepared to do right now. Infrastructure spending, every economist will tell you, is great because it adds to short-term demand, and we need some of that to get up to that 3% figure. But we also need it because it's something that boosts productivity and income over the longer haul. And if we're building these long-life assets that are going to last for 100 years or more, I can't see any reason why the people who will be using that rail line in the future shouldn't be making some contribution to the cost of building it, and borrowing money to fund that infrastructure is a good way of sharing the costs over time. For businesses, I think we need to see them also lift their capital spending, and to do that we need a more, I think, kind of realistic appreciation of the opportunities on offer. And what stands out really is what you can see on the chart on the right-hand side. It looks at the hurdle rates of return that businesses use when they're evaluating investment projects. And most businesses say they're looking for something like a 10 to 16% rate of return before they will put some money to work. And in a low yield, low return, low inflation environment, I think that's going to be quite difficult to achieve. Now, I spoke last week at a Lunar New Year function, so it was all about the year of the rooster. And one of the things I pointed out there, that there is a big new rooster on the global stage that we're all going to need to pay a lot more attention to this year. And that, of course, is President Trump. He's already had a big impact on financial markets around the world, the so-called Trump trade, as it's called, which means that every time you get a positive tweet from the White House, you're going to see US equities rise, US interest rates rise, and the US dollar strengthen. Equally, when there's a negative tweet, we're going to see some of those things reversed. Moving beyond that, though, I think the President will also have a significant impact on economic activity in the US and elsewhere. And certainly his policies are going to be expansionary for the US economy. They're also going to be inflationary. And because of that, it's quite likely that global interest rates will be higher than otherwise. So in our businesses, we should certainly be prepared for a higher interest rate backdrop that we've seen before. Tax reform is clearly going to be important as well, not just what they may do in the US, but what happens in other countries as well. Just two final points I really wanted to make is that while interest rates will be going up, they're likely to remain low overall. And this chart here shows you the longest run chart I have in my collection, history of interest rates over the last 5,000 years. It was designed to prove that interest rates today have never been lower, and that's true, but it also proves that the low interest rate environment is one that's normally there most of the time. So if you exclude that temporary period during the Babylonian Empire on the left, the real aberration in interest rates is what you can see towards the right-hand side there. And an extended period of low interest rates, even if they're high today, will also need to be thought of in the way we operate our businesses. And finally, just a word on the geopolitics, because I think it is important. There are 12 animals in the Chinese zodiac. I want to add a 13th animal in for this year, and that's the elephant. This thing here is called the elephant curve. There's a quick hint about why it's called the elephant curve. But what it shows you is income growth in the 20 years up to 2008 around the world. The further you are on the left of that chart, the poorer you are. The further you are to the right, the richer you are. And most of those income groups went ahead, except for around that kind of 70th to 90th percentile where they went nowhere. And that's where most of the middle income groups in the advanced economies sit. It's a big disillusioned group there who see no benefit at all from the economic reforms that governments and economists like to talk about. And that explains, I think, much of the surprising developments that we've seen over the last year and potentially this year with a range of elections in Europe in particular coming up. I'll finish at that point, and thank you for your time today.